Hello viewers and subscribers, and welcome to today's video. In this video, I will be continuing with the financial statement analysis process, specifically focused on assessing balance sheet quality. Similar to the earnings quality analysis I did in the previous video, I will pose certain questions you should be asking, perform a common size analysis, a ratio analysis, and identify red flags to look for. Whether you're an investor or a business owner trying to understand the quality of your balance sheet, knowing how to perform a balance sheet quality analysis is essential for making informed investment decisions or improving your company's performance. Join me as I break down the steps to a great balance sheet analysis. Balance sheet quality analysis. The balance sheet shows the financial condition of a company. It shows assets, liabilities, and equity. It tells you about liquidity, whether the company has adequate cash to meet its operating expenses. Insufficient liquid assets could lead to bankruptcy. A high-quality balance sheet, assets and liabilities are properly valued, assets and liabilities maturities match, it's highly liquid, and it has manageable debt. A low-quality balance sheet has hard-to-value assets and liabilities maturities mismatch, it has poor liquidity and large debt. When doing balance sheet quality analysis, you should weigh high-quality features against low-quality features to determine the overall quality of the balance sheet. The first step in balance sheet quality analysis is to answer some relevant questions. Are the assets and liabilities fairly stated? Are there hard-to-value assets or liabilities? Do asset maturities match liability maturities? How liquid is the balance sheet? Are there overseas or restricted cash? Does the company have a lot of debt? The first question, are the assets and liabilities fairly stated? You cannot tell this from just looking at the balance sheet. Review footnotes, MD&A, which is Management's Discussion and Analysis, and SEC comment letters for major assets liabilities. Look at qualitative and quantitative factors as these affect valuation. Factors affecting asset liability valuation, things like under or overstated reserves, for example, bad debt allowance. Understating this could mean that your asset is overvalued, and overstating it could mean that the asset is undervalued. And the asset in this case would be receivables, as bad debt allowance is a reserve created for receivables. Impairment could lead to lower asset values. Some indicators of impairment include falling profits, unprofitable segments, and loss of patents. All these could lead to assets being impaired. Continuing with factors affecting asset liability valuation, deteriorating operating performance. If the company is performing badly, there might be pressure to overstate assets or understate liabilities. Pressure on management, that is. A qualified audit opinion could affect valuation as well. Internal control weaknesses around assets and liabilities. These are all factors that could lead to potential falling asset values. The second question, are there hard-to-value assets and liabilities? Hard-to-value assets and liabilities require significant judgment and assumptions in order to value them. And these include things like level 3 securities, for example, private debt and equity. Management has to value these things. There's no ready market price for them. Over-the-counter derivatives, they do not trade on exchanges. Intangible assets, contingent liabilities, for example, a legal judgment against a company. All of these are very difficult to value and require a lot of management, judgment, and assumptions, and are therefore prone to manipulation. Hard-to-value assets liabilities increase the risk of misstated or fraudulent balance sheet. Third question, do asset maturities match liability maturities? Look for mismatches between asset and liability maturities. For example, if assets are mostly non-current but liabilities are mostly current, you have a mismatch there. Might be unable to meet short-term obligations if they mismatch. Pay attention to cash and debt mismatches. That is short-term debt, but little cash and liquid assets. So if a company has debt maturing in a few months, but it has little cash and other liquid assets to pay this debt, then it could have some problems meeting those obligations, and this could affect the company's operations. How liquid or leveraged is the balance sheet? That's the next question. Liquidity ratios include current, quick, and operating cash flow ratios, and these ideally should be above 1. Leverage ratios such as debt to equity or debt to capital, ideally these should be below 1. Interest coverage should be above 1. There are exceptions for some industries. For example, real estate investment trusts are usually highly leveraged, and this is a feature of their business because it's a capital intensive business, and they usually borrow a lot of debt to buy their properties and so on. So that's expected in this business model. So as I said, use of debt is part of the business model, but the company still needs to generate cash to pay its debt. So despite it using debt and that's expected, it still has to show that it is generating enough cash to pay this debt. Continuing with how liquid leverage is the balance sheet, cash held overseas, taxes due if repatriated, and you can find this in the MD&A tax footnote. So if the US company is holding a lot of cash overseas, it might have difficulty bringing this cash home because it has to pay taxes on that cash. Off-balance sheet contractual obligations, again, you'll find this in the MD&A, things that are not on the balance sheet, but the company has an obligation to pay those. That might affect the balance sheet quality. Debt covenants, you'll find these in the MD&A or a debt footnote. Is the company close to breaching these covenants? Does it have the ability to refinance? These are things you'd want to look at. Some companies may borrow at the beginning of a period and repay at the end to hide its true debt. And you'll find this in the MD&A and in the debt footnote. What some companies do is they borrow the money at the beginning, use it during the period, repay at the end of the period before the financial statements are finalized and issued. And then it borrows again at the beginning of the period, so it actually hides that debt. That was step 1 in balance sheet quality analysis. Let's now look at step 2, where we do a common size balance sheet. Vertical analysis, you express assets, liabilities, and equity items as a percent of total assets, and liabilities plus equity equal assets. Horizontal analysis, compare the change in balance sheet items year over year. For example, receivables increased over prior year significantly. What's causing this? You'd want to look into that. Here's an example of a common size balance sheet, and we have both vertical analysis and horizontal analysis. And for vertical, everything is expressed as a percentage of assets. Cash in 2023 is 46% of total assets. Total assets obviously is 100% of itself. And here we see, for example, just pick something random. Accrued expenses is 12% of total assets. That's vertical analysis. Horizontal analysis, we look at year-over-year change, and we see marketable securities here up 209% in 2023. And moving down the line, looking at something else, we see where long-term finance lease liabilities are down 13%. So that's how you do the horizontal analysis for the balance sheet. And just look at a few observations here. We see where inventory increased 60%, but it remained unchanged compared to total assets. So let's see if we can find that. Inventories, horizontal analysis up 60%, but it's still 3% of total assets for both 2022 and 2023 when we look at the vertical analysis. Marketable securities increased significantly. So we see marketable securities 209% here, the current portion. And then I think there's a long-term portion which is up 2,126%. So this company had a significant increase, and you'd want to look into that to see where that cash is coming from. We see where other assets up 119%. You want to look to see what is causing that. We see where accrued expenses increased 25%. This could be the company's creating a cookie jar, or it could just be a normal increase. as it remained consistent as a percentage of total assets. So though it's up 25% when you look at the horizontal analysis, vertically it's still 12% of assets. So that might tell you that it's just a normal increase as the business itself grows. So those are some observations we see from this company, and that is how you'd set out your vertical and horizontal analysis. And that's it for step 2. Step 3 is ratio analysis. Ratios examine the relationship between financial statement items. Review for large, unusual changes and trends in ratios. Look at ratios over several years. A single year change could be misleading, so you definitely want to consider it over several years. Worsening trend is more troubling than a single bad year. Liquidity ratios measures a company's ability to meet short-term cash needs. Asset liability turnover ratios looks at how quickly assets and liabilities are converted to cash or sales. Asset liability turnover ratios look at how quickly assets and liabilities are converted to cash or sales. Solvency ratios looks at a company's capital structure, that is the level of debt or equity used to fund operations. Here are some ratios and things to look for when analyzing these ratios for balance sheet quality. The quick or acid test ratio, this is a liquidity ratio, and it's current assets minus inventories over current liabilities. Measures a company's ability to meet current expenses, and look what to look for. If it's below 1, current liabilities might not be covered. Cash ratio, this is another liquidity ratio, and it's cash and cash equivalent over current liabilities. Measures a company's ability to meet current expenses. Below 1, current liabilities are not covered. Operating cash flow, this is another liquidity ratio, and it's operating cash flows over current liabilities. Below 1, operating cash flows are not covering liabilities. Days sales outstanding or DSOs, this is a turnover ratio, and it's receivables over revenues divided by 365. This measures the time taken to collect receivables. A higher ratio means it's taking longer to collect receivables, and it could suggest that the company is having collection issues, could lead to possible write-offs, and impacts receivables value. Days inventory outstanding or DIOs, this is another turnover ratio, and it's inventories over cost of sales over 365. It measures the time taken to convert goods to sales. Higher value means the company takes longer to convert inventories to sales, and it could lead to obsolete inventories, potential write-offs, and impacts inventories value. Continuing with ratios, debt to equity, this is a solvency ratio, and it's total debt over shareholders' equity. It measures a company's dependence on debt to fund operations, how much debt is used in the company's operations. A higher ratio means that the company is using more debt, and this is typically not good for the company if it's using too much debt. Debt to capitalization, this is another solvency ratio, and it's total debt over total debt plus shareholders' equity. And similar to the debt to equity ratio, it looks at the company's dependence on debt to fund operations, and the higher ratio is typically worse than the lower one. And that takes us to the final step for balance sheet quality analysis, where we put it all together. And similar to the earnings quality analysis, you combine your findings from steps 1 to 3, that is asking the relevant questions, performing your common size analysis and your ratio analysis. And you combine the findings to assess the overall balance sheet quality. So you document your findings, combine your findings with the earnings quality and cash flow quality analyses, and some industries are harder to analyze than others. Consistent process improves analysis and decision-making capability. So always strive to improve that process and make it better all the time. And that is it for balance sheet quality analysis. Just as with earnings quality analysis, balance sheet quality analysis is very important for understanding your business, whether you're an investor or a business owner trying to improve your business's performance. Understanding the quality of a company's balance sheet and whether it can sustain its operations is very important. I hope you learned something from this video and hope to see you in the next video. Remember to like, subscribe, and share the video with your friends and colleagues. And join me in the next video where I will be continuing the financial statement analysis process, specifically focus on cash flow quality analysis. The final financial statement analysis we'll be doing in this process. See you in the next video.